So, for those of you joining us again, welcome back to our discussion on financial health and credit with Mike Taveira from BayCoast Bank. And for those joining us for the first time, go back and watch part one because this is part two.
And part one was awesome.
And part one was awesome. Yes, it really was. So we want to, of course, thank our sponsor, BayCoast Bank. BayCoast Bank is just right for all of your financial needs. Visit BayCoast Bank. BayCoast.bank or call 508-678-7641 to learn more. And as always, you can support the 27th Degree with Chris and Nancy by subscribing to us on YouTube or your favorite podcast platform and by following us on Facebook and Instagram. So we'll get right back into this.
Yeah, so we were talking a little bit about the 30% rule and keeping all the balances on the credit cards under 30%, but I kind of wanted to back up a little bit to the beginning again. So someone that's just starting to build their credit, like that 18-year-old who's maybe going off to college or graduating high school, what's typically like a newbie score?
Well, they're not going to have a populated score at all. So I've actually ran into this a couple times in the past 3 months and the people were older and later in life too. They just lived by the old school rule. Like if you don't have it, don't borrow it.
Yeah.
So they just don't populate a credit score when you don't have any trade lines. So it'll say, when I pull that person's credit, it'll give me all their information and everything. It'll just say not scored, insufficient data. So when that happens, that's why younger people especially, the earlier you can start with something small to like build responsibility and kind of coach them through it is awesome, because if they keep that open, that's the quickest way to have like a long-term credit line. So like we talked about in part one, where credit is built over time. If somebody doesn't get a small credit card or a store card until they're 20, 21, they've missed out on 4 years of their snapshot that they could have started at 16. So when they go to buy a house at 24, 25, if they're already on their career and they only have that one trade line and one credit card, the snapshot's very small. So they can miss one late payment. Their credit history is only 3 years long. That one recent payment will impact them down to the low 600s. But if they had 7 years and that only had that one late and it was recently, which will impact it a little more, but they still have that 7 year, and it makes it weighted differently. So their picture will look better. They'll still that score will be more solid. Okay. If you don't have that history, it's easy for one little event to impact the score more.
So really, I mean, it's as soon as possible. One should probably start their credit journey and get a credit card. And I know a lot of parents, allow kids to maybe use their credit cards, and that's not necessarily good for the kid.
A little bit dangerous,
Why?
So it can work both ways. I'll give you both aspects of it. So they're coached up to where they want to be added as an authorized user because it builds their credit, because it'll actually show up on their credit report, even if the trade line's older than them. It will still show up on their credit report if they're an authorized user, because they're allowed to spend on it. So technically, if they're allowed to spend on it, the credit bureau thinks it's their debt and they're paying on it monthly because they're spending on it. So when it comes down to it, that can be very positive, because you could now have a very long snapshot being an authorized user, because that account could be 10 years old.
I hadn't thought about that.
But also, if that's their only trade line and the parent misses a payment, it's going to destroy their credit. So it's very tough, because now that looks like their full picture.
So they're really linked.
Yeah. So if it's an account that's always been paid on time, that's going to be paid on time, it's a very useful tool. But when you don't want to ever rely on somebody else when it's your trade line, so I would say starting early and having your own account, even if it's backed by a bank account, if you can't get credit right away, that's the way to go, because it teaches responsibility. You'll see the repercussions of if you do miss a payment. And I think that's what most people haven't done. You know what I mean? And as kids, we didn't know to open accounts. We were like, we don't. I know before like probably 18, I didn't even know if I would be accepted by any store. I mean, like, I would walk into stores, they'd offer me a card for clothes, and I'm like, there's no way I'm gonna get that. I work at blah, blah, blah for $7 an hour or whatever it is, right? So you don't know until you know, and that's a great way to build it up yourself when it's your own trade line and you're responsible for it and it's always on time. I think that's the best way.
So then with kids, like what counts on I guess we can play a game of yes or no.
Yeah.
So what counts on a credit score? Does your credit cards, obviously.
Always. Yep.
Utilities.
Nope.
Um your financial loans for school.
Yes. So a lot of those on student loans, they're going to show up way before you, as soon as you take them out, like the day you take them out. So freshman year, it's going to show up on your credit. Now, you may not make a payment for the next 5.5 years because it don't kick in till 6 months after graduate, and that's when the first payment is. So it'll sit there as a trade line. It'll say payment deferred. It'll have the balance, and then it'll just say zero payment. Now, the kind of like the craziest part is a lot of people who go through those student loans, they're borrowing them by semester. So they don't,
Right.
a lot of the times they don't add to the balance of the old loan. So they have 15 trade lines. You know what I
Right.
mean? So the first semester is $3,700. Second semester, new trade line. They applied for new credit. Now they have a $3,800 balance on a new trade line.
Right.
So these college students now actually have 10 to 15 trade lines, and they don't even realize it. Like, oh, I have one balance with them. Here's my payment monthly. The statement is going to be, or my payment's going to be this when I graduate. And they do put it as one big balance because it's more convenient, and it looks a lot more scary when you have 10 loans out. But on credit, that's not how it is, because you open that debt at this date. So they can't add it to that balance because it's a new trade line. It's new debt that you've acquired. So a lot of student loan companies are realizing, like, wow, we're littering. Like, there's some people that if they're in a professional, lawyer, doctor, whatever, they're in school
Right.
for 7 years. I'm scrolling the credit report and like it's 10, 11 pages, and they don't even have a credit card because they're just like, it's the student
Right.
loans are one after the other. And for mortgage purposes, they're just because they're deferred doesn't mean I don't have to count a payment when you go
Right.
to buy a house. So depending on the loan program, sometimes I have to put 1% or 0.5% of the balance for each one of them as a payment.
Oh.
So these people, they're like, I don't have a bill monthly. How is my debt ratio so high? And I'm like, well, you have 20,000 here, 30,000 here, 20,000 here.
Right.
1% of it's $200 or whatever, and then 300. So you actually have $1,000 in payments counting it towards you, even though you don't have a payment monthly.
Right.
Yeah.
How do you figure in, like, with all the talk on the loan deferment and like, you don't count that at all until it actually happens and it's signed off on?
You mean like you're talking about the forgiveness or the actual like
Well,
deferment of the payment?
The forgiveness
Oh, I mean, I feel like I've been hearing about that for
for like
a couple
10
of
years.
presidencies, but yeah. So, I mean, we have to count every student loan or
You do.
debt against you and a certain percentage of it, even if there's no payment right now. So we or any lender couldn't anticipate forgiveness because a lot of it has to do with income levels and when you got the loan, and who knows what the parameters will be when it tries to happen.
Convoluted.
So we always have to take worst case scenario and underwriting a loan. So you're going to have those payments until they're actually gone off your credit report. That's when they won't be counted against you. Yep.
So what about the FAFSA loans? Is that like a new loan every year too?
I don't want to speak to something that I don't know the application process, but I know obviously there's federal and private loans.
Yeah.
It seems like when they talk about that stuff,
Guess
as
if you're
far as
doing a new
forgiveness or something,
application
then
every
yeah,
year.
like you'd have some that may be forgiven, some that won't, and then
Right.
the FAFSA is like the aid.
Yeah.
So when you're getting aid, it should not be in your balance that you owe because they're paying a portion of it. But I don't again want to speak to anything that I don't know the numbers on it. But in logic, it would be what you're responsible for on your credit report.
So then, if we're talking about that 18-year-old, and is that the earliest age you can get your independent credit?
No, you could. I mean, you could get a credit card and start paying on it at 16 or whatever you
really?
need. Yeah. A lot of people or parents could do it where a lot of the times you can't get a trade line or a credit line that young, but there are certain cards that you can back it with a bank account. So, so it reports to your credit. You're getting credit for the payment of it, but it's secured by like some sort of bank account so that the bank knows like, all right, we're not giving a credit card to 16 or whatever it is that doesn't have employment or whatever it is. But a lot of those, that's how you start out, is like a credit card that's backed by some sort of account.
Mike, are those the credit cards too that someone who has had a bankruptcy should start out to help
That's a great
build
way to
their
do it.
score back up?
I'm seeing a lot more recently people being able to rebuild out of a bankruptcy without that. But if you keep getting turned down for small cards, that would be your way to go. And there's a couple of different options without like naming companies, but there are a lot of different options that are backed by it. And the key is that it's going to be reported to credit, because sometimes you have those cards and they don't report to credit. But if it is, that's the benefit of doing it. So make sure that they are reporting to credit.
If someone's really trying to build up their credit, and sometimes it seems like, it takes so long for your credit to creep up, but then like you forget a payment and boof, you're down in the cellar again.
Yeah.
Like it is 6 months like a typical time period? Like you had mentioned, you have a little tip sheet for your clients on how to build your credit. Do you normally see like within a certain amount of time?
The tip sheet really is so specific to your credit. So it's not just me being like, don't have anybody pull your credit and pay your bill on time. And it's like the fluff. It's not very general. I'm like, when someone's credit score is a little low, even if it's not a little low, our software actually spits out, with this account, if you bring it down to this balance, this is how much your score would go up. So it's not just generalities of like what to do to keep your credit up. It's like, you have this account and this is the balance of it. But if you brought it down to, and it's not just a suggestion, it's like to the dollar of what it should be. Now, like this would get it up 21 points. So I have people doing that on a daily basis and like going through their plan that I gave them in a month or less, we can get it up to where maybe in different loan programs available to them or whatever it may be. Sometimes it's easier when they don't have like super high balances, because not everybody, they're like, if I had that much money, I would just pay it off. You know what I mean? It's
so this is all personalized to
it's personalized, and that's free. Like I do it for everybody that I pre-approve, because we can all benefit by that person's credit score being higher. So while they're searching for a home, sometimes it's taking 3, 6, 8 months. I say, hey, this isn't going to hurt. Do these things on your credit while you're in your search. Your credit score may go up to this potentially, and let me know what you execute on, and then if it takes 6 months, we'll repull your credit. Your score will be higher. You get a better interest rate or lower PMI or whatever it may be.
Is this all based on a software program?
Yeah. So we have we use a company called Advantis. They are our credit report company that gathers the 3 bureaus.
Okay.
Their software is strictly like licensed to them, and it tells you, I call it the what if mode. You can play around with it and say, what if I did this? What would my score be? You can play around in what if, and people are amazed by like small accounts. They're like, really? Just that one account, bring it down to this or that. And it's sometimes they're, depending on how long their credit history is, sometimes it's a big jump. And like nobody's ever told me that. I've had like 10 people pull my credit. Nobody's told me that. And I'm like, it honestly, it gives you the plan, and sometimes I'm amazed by it. But me looking at the credit report, I would just not be guessing, but I'd be like, that account's always been on time. I don't know if that's the most important one. This one seems more important, that had a delinquency or a collection or whatever.
The software can tell you that.
It tells you, because it's creating and knows the algorithm of the score. So
that's great.
It's like a cheat sheet. It's basically having the cheat sheet for your credit score.
Suppose you're not going for a mortgage, but you just want to work on your credit score.
Yeah. I have people that do that with us. I mean, essentially, I'd put it as like an application, because we got to figure out what your motivation is to buy a house or do something. But I gladly coach people through, because like I said, whether you're a buyer now or 2 years from now, or whatever you got to work on, in everybody's situation is different. You want to be in that best spot. So those are the people that are most grateful for me spending time with them. So I know they're going to call me back when they are ready.
Right.
Yeah.
So that makes a lot of sense to me, that, and the fact that you can do that, I think it's fabulous. But I hear these products that they sell, like Experian Boost and all this stuff.
Yeah.
Press a button and your score goes up
Yep.
by whatever percent. How does that really work? That seems like
So it's
seems a
funny,
little
because
funky.
like a lot of those companies, and especially that program specifically, it doesn't translate to your mortgage lending credit report.
Okay.
So they're instantly doing that boost and giving you a suggestion and telling you what to do. And then they're going to show you their experience score and what it did to it. But it doesn't, and almost most likely it won't translate to your mortgage lending score.
Okay.
So it's another way for them to make money.
Yeah.
When
so I
when we
figured.
talk about scores, can you kind of group the scores into
Yeah.
like a score like you got to really work on this, baby, and then like an okay, fair score, and then a score that's going to
Good
really
and
put you
excellent.
in.
Yeah.
and-
I mean, without giving you
standing.
generalities where it's not really like
Right.
registering in people's brains, like I can say 740 and above, you're great. And then like, what does great mean? I want to translate it to something like
Yeah.
monetarily that it's great for you. So
Right.
like, I would say like everybody says 8 to 850 is excellent. And I'm like, that is absolutely excellent. But I would say less than 5% of the people that I pull their credit have 800 plus credit. So you're really probably getting the best interest rates at a 760 plus
Okay.
clip.
Okay.
And then it really goes in tiers of 20 points. So 740, 720, 700, 680.
Mhm.
Like conventionally, to stay with a conventional loan where you're getting rewarded for your credit score, you really want to be above that 700 to 720, which I would call good credit. 700, 720 and above.
The 760 is stellar.
760, you don't have worry about, like, you're getting the best interest rate. You're getting probably the lowest PMI. So it's the best tier to be in above that. 780 and above, like, you really, it's like not even looking at it. You're like, that's the best deal. So
Mike, is that true for like most loans too, like outside of mortgage loans?
yeah,
Car
so you'll
loans and
see like on car loans, you'll see every bank's website is different, but they'll put this rate for 780 plus. So it's how they're splitting it.
Yeah.
But you'll see it's usually split at 780
Okay.
for the best interest rate. So
780. Okay.
yeah.
All right.
So when you see like on someone's website, like the car has to be newer than 2020 and
Mhm.
780 credit, that's their best borrower.
Okay.
Yep. But it really, the more important aspect of it is when you have lower credit score, because you're working on improving it to get to a benchmark. So technically, like you really want to be above 680 to be a conventional loan and have conventional financing be reasonable for you, because the PMI will be comparative and the interest rate will be close. 680 and below, I always look at an FHA option because they're not punishing you for your credit score as much as conventional would. So I'd say between 580 and 680-ish. That's when I at least compare the two options and show them like this is what it's costing conventionally and FHA. It's almost a no-brainer to go FHA below 660. Like
Okay.
the PMI is much cheaper. The interest rate isn't punished as bad. So that's kind of the tiers. FHA, you want to be 580 to 660. Conventionally, it gets a little maybe not between like 680 and 700. And then 720 and above, you go conventional.
Okay.
Yep.
So then we talked about the staying under the 30% of your each card balance, not total credit card balance. Well, what are other ways that you can start to repair your credit reports?
So the great part about it's two things I wanted to talk about that most people actually don't know. And when they came out, I was very surprised. And I was like, oh, this is great because this is a major hindrance to people in seeing their lower credit score. So the things that I saw most commonly that people never knew about and they were heavily impacting your score was a bill that was supposed to be paid by your insurance company, and it's a medical collection. And it was up until July of 2022, they could throw it on a credit report no matter the amount. And it was, well, as of March of this year, it had to be above $500.
Okay.
That's a big change because they were throwing on $100 medical collections and it was affecting people's scores, and people didn't know the insurance company didn't pay it. It was their responsibility and blah, blah, blah. So, and it wasn't something that was getting caught by these agencies. Like it was on your credit report, but it wasn't something that you were being alerted by. You probably got a letter in the mail from your doctor or
Right.
whatever, but you were like, all right, I have insurance, and it paid it. I mean, I'm like super like anal about those things. So I would call as soon as I got the bill anyways and be like, did my insurance company pay this? But
Right.
a lot of the time you think you're covered for things that you're not. Now, so in March, it had to be over $500. That's a big change. And last July, it changed that the collection had to be for a year. So it couldn't be just like 3 months later, oh, nobody paid this bill, let's throw it on someone's credit report.
Okay.
So it has to be a collection for over a year to hit your credit report.
Okay.
So they would have multiple notices to you that.
Okay, so that's good. That's just for medical.
So what
stuff.
happens
Yeah.
like if like you didn't get that cutoff? Does your bill still, does it fall off or is it still there? If it's
Yeah,
under
no. So that
500?
was moving forward. So
Okay.
any collection that you have that like originated, let's say in what? So it's August now. So let's say last August, you're after the deadline. So they would have had to wait till this August
Oh.
to put it on your credit report, and it had to be over $500.
Okay.
Yep.
So, Mike, we talked a lot about the kind of the do's and don'ts.
Yep.
But there are some things that are out of our control. So, if someone is, for example, a victim of identity theft,
Yep.
what happens with that?
So there would be an investigation. A lot of the times the credit bureaus realize, because there's going to be some sort of formal investigation into that.
Mhm.
So the credit bureaus are alerted. So most will immediately freeze your credit report. So any new debt that's trying to be acquired can't happen. Like companies that are pulling your credit are alerted that you have to verify that this is the person that's applying for it. So that's a good protection for you, because as soon as they freeze your credit report, that like it wouldn't even show me. It'll just say borrower's credit report is frozen. Now that happens every so often on the mortgage side, because people sometimes choose to do that in their own protection 24/7.
Sure.
So then I have them call the credit bureau and they unfreeze it for 24 hours and then I do it. But when there's some formal investigation into your identity theft, that is a protection for you. So it'll get frozen. Now, if they're doing damage and the damage is already done, it's due to Fair Credit Reporting Act. They have to be diligent on a debt that wasn't yours or was fraud. It has to be wiped clean of your credit report. So that'll be a result of the investigation that happened. But they're pretty good about that because the laws are in place now to not have fraud on your credit report. So there might be a painstaking, like whatever amount of time that's going on, that you're seeing things on your credit report, but it should be all sorted out because it'll be very easy to see what was your debt, what was your not your debt, when it originated, how was things spent, because that company is going to have restitution with you because your balances need to be correct if someone spent and stole your identity.
Yeah.
So there's going to be a lot of sorting out with both of those things, but you'll be impacted probably while it's happening, but there are things in place to stop it and then stop it from happening more where people can't acquire credit.
Right.
Yep.
So, I mean, freezing your credit in a way can be a safeguard from this
Definitely.
stuff.
Oh, definitely.
But your credit won't build, though, after that, right? Or will it?
No, it will. So
It
it's happening. Your credit is still happening and it's evolving every month. It's just blocking companies from accessing your credit report without your permission.
Okay.
So it's still running the same exact way. It's just it's like basically having a jail cell.
Yeah.
And you're like, all right, you're let in. You're not.
So you're still, you're paying your bills, your credit is improving, hopefully. But if someone then wants to open a credit card in my name, they're unable to do it because when they go to pull that credit report,
It'll say
says
frozen. So that creditor can't make a decision on it because they don't have a score.
Right.
Yep.
Okay. Interesting.
Primacare is Southeastern New England's trusted leader in medical care. With offices in Fall River and surrounding communities, we're dedicated to your well-being. Our carefully selected team of more than 150 providers offers world-class primary and specialty medical care. Primacare doctors are supported by a skilled staff trained to deliver comprehensive radiology, imaging, and testing services. Primacare is large enough to take care of all your medical needs, but small enough to care for you personally. Primacare is by your side.
So I want to backtrack a little bit because you said there were two things that surprised you. So the first one was the medical bills.
So
What
those
was
are the two.
second one?
The 1 year has to be over 1 year old, and then
Okay.
the plus that over $500.
Okay.
Because back in the day, I was in a different mortgage lender, and it's mostly refi, and I was looking at probably 10 or more people's credit a day. I would see that. So it was so prevalent of like very small medical collections and just reporting to one bureau, and then like them reporting to different one bureau. So they would hit you for different amounts in different bureaus just to screw up one or two scores. So that if you went for a mortgage, they know they screwed up 2 scores because it was going to impact you. You know what I mean? So it was a game, and I think it kind of while it didn't put an end to the game because they do need medical collection reporting. Obviously, there's a debt that's owed. It was less of a game now. It's like you have to wait a year. This person was notified 5 times that the bill was there and somebody needs to pay it, the insurance or them. And you can't just throw it on a credit report now and then nobody answers the phone when someone pays it because it's still lingering on the credit report because they got their money and they don't care about taking it off the credit report.
Right.
Because after they got their money, that was the biggest thing about collections, with people buying debts from whatever doctor's offices for pennies on the dollar, because collecting a debt that's probably maybe not going to get paid. And then when they did get paid or settled, they just never went back to the bureau. So the person paid it to get rid of the pain point, and then they didn't care about not because they got their money. They didn't care about. But fair credit reporting now, you have a very clean process where these companies are obligated to pull it off as soon as it's paid.
So I'd like to say 2 things. Are you ready?
All right, I'm ready.
So
Brace myself.
Okay, you ready?
Yeah.
So the first one is just unexpected bills, and there is some negotiation there for payment plans and everything else. My husband just went for a surgery, and there was an additional $2,000 cost that came out of the blue. We just didn't expect it. No one had ever talked about it. We got this bill, and we're like, oh my God. So, we were able just to call and do like a payments, and they were like, oh, we can do a 3-month plan. I'm like, well, that isn't going to work. Can we do like the 12-month plan? And so a lot of people are very open to doing plans to suit you.
They'd
So
rather
just
get that than nothing.
Yeah.
Well, yeah. So I just want to make sure everyone knows that you can talk with someone over these bills and what have you. And
point.
also then with collections, I know a few people who had some bills in collections, and they had a certain amount of money in front of them. They would call and say, I want to take care of this bill. It's for $800. I have $600 or $500. Will you take this and clear it?
Yep.
And a lot of times they did. Can you talk about that in your experience?
So it's the reason they do that is because here's how it the back door side of that story. So the people that you owed the bill to tried to collect on it for a certain amount of time, and then the collection agency buys it for pennies on the dollar of what you owed them. So them settling with you is actually a win for them because they paid way less for the debt than you owed. Okay. And so if you're basically meeting them in the middle, and they're still making their money from buying the debt. So that's the logic behind why you can negotiate, which most people don't do because they think that it's not going to go away or whatever. But it's what I say to those people is you should negotiate, especially if it's an older collection, because that confidence that the debt might have been sold 2 or 3 times for less and less money to different companies, because it's getting less confident that that person's going to pay that bill. So when it does happen and you negotiate a collection, that is a great way to do it. Just always get a paid in full letter with the account number and all the specifics of what you're paying off, because while it's not every time that collection agency while they say and they're supposed to abide by certain rules, you want it off your credit report. That's the reason you're paying the bill, unless I mean you have a moral obligation to. But when it comes down to it, that's the reason you're paying it. You know what I mean? So it's to get it off the credit report. So you need that letter, because if it doesn't come off the credit report, you have the evidence and you can send it to the credit bureau and get it off there.
How are credit bureaus to deal with? Are they like if you see something erroneous?
I think it's a lot better than it was, and I would say certain ones are better than others as far as getting live people on the phone. They like automated. They like using the website and obviously not paying people to answer calls because I mean the calls to credit bureaus are usually not great calls. They're aggravated. You know what I mean? So like it's not something that you want to be the punching bag on the customer service side of a credit reporting agency, but they're definitely better, and the Fair Credit Reporting Act made it a lot better because they're obligated to take things off if you can't prove that you owe them, or even if the company can't prove that you owe the bill. So they can't just throw it on there anymore. So when you have proof of payment on something, and that's the key thing, they're gonna get it adjusted and get it off there. That's why when I'm doing those what if scenarios for better credit, I always say just don't pay it down. Just make sure they give you proof that you paid it off as soon as you do it, because if they don't do it, then we're gonna send it and we're gonna get it taken off, because I'm going to be like the facilitator in getting your score up, but I need proof. Like if I'm the lawyer, I still need to find the proof to get you off. You know what I mean?
Yeah.
Yeah.
So then to summarize our little topic on really specific ways to increase your credit score, repair your credit score, we had talked about staying under the 30% utilization, maybe being added to a person's credit card that has good standing, taking care of the bills and collection. Anything else?
Yeah, I mean, there's a great resource, annualcreditreport.com.
Okay.
That's truly your only free copy of your credit report. So while there's great apps out there and there's credit agencies like third parties that will coach you on credit or kind of charge you a monthly fee or something for it, it's been the same way for a very long time. Annualcreditreport.com is where you get your free copy, and you get one free per year, and that'll be your actual copy that a lender's using to make that decision. You can look at it yourself, and you can get a free copy every year, and that is that's a trusted source where if you're using a company and you're getting some other version or their algorithm, you may not know your score or your actual credit report of what it looks like. They're probably going to have access to it, obviously, but there's going to be some sort of fee involved or monthly subscription or usually some catch to it. Annualcreditreport.com is what I tell people because it's a site that you're going to get the facts and it's free.
Does it give you your score too? Or just your report? You might.
It'll be your actual report. I think if you do that one yearly, you would get your score.
Okay.
Yeah.
And of course, if they come to you and a customer's looking to buy a home or whatnot, they can get a really detailed plan on how they can improve their credit.
Yeah, absolutely. I use that as a tool even when the person has great credit because, well, it can't hurt. You know what I mean? It's free, and everybody loves to learn a little more about their credit report. And I've seen people with 760 credit, and it said it could get it up 25 points. And I just print it out for them. I send it to them in an email, and they're like, "Wow, all right, I'll try to keep that at this, and I'll pay that down to this." And I'm like, "Yeah, can't hurt." And it took them 3 months to get to find a house because it's so hard to get your bid accepted now that it actually improved, and he got a little bit better rate on the conventional side.
Interesting.
Like when you have like 25 credit cards out versus like 5 credit cards, is that hurting you? Do you look at like, okay, you can go charge tomorrow $100,000 and
you would never want to have that much out there. I mean, there's probably a happy medium somewhere between maybe 3 and 5 of like open credit lines. Because while let's say you did have 25 open credit cards and even with very small balances, you have the potential to basically max out and have a terrible debt ratio. So if it's something you're not using, I wouldn't say, it's very tough to say everybody's scenario under a blanket, like this is how it should be, because you don't want to close older accounts because even though it might be a bad interest rate, you're going to lose that snapshot as soon as it's not active. If you close it, you might have had that card for 15 years. Now you lose that credit history. If it's open, it's still part of your
Really?
your
So you
active
actually
debt.
lose that credit history?
Yeah. So the only time I would say or advise anybody maybe close it is if it's an annual fee. So if you have an annual fee on something and you don't use it, you're not going to pay $90 a year just to use it and just not to lose the credit history. But if it doesn't have an annual fee and you don't have a lot of credit cards, I would keep it open, especially if it's been a very long time, because it's part of a good picture.
I didn't know that the history goes away when you close a credit card.
It's still going to
That's
be at the
interesting.
bottom of your credit report, but it's going to stay closed and not active.
Okay.
So
Alright.
the accounts that are active are going to stay towards the top.
Yeah.
So those are the ones that are going to be weighted more heavily and that you're using or not using or have the potential to use. So that's going to be part of that pie.
Yeah.
But so as soon as you push it to the bottom of the credit report while closing it, you're losing that history that you built up, if it's good history.
How about credit versus debit cards? Do debit cards help?
So they're not reported to credit, so it wouldn't matter.
It doesn't help.
Yeah, it's not a trade line. So you would basically say anything that's going to be a trade line that pops up on your credit, that's going to be affecting your score. So debit cards, no. Utilities aren't on your credit. Leases are, so like sometimes you'll have a solar lease or like obviously an auto lease. Those are things that are going to be on your credit. Lately I've been seeing like installments for like, we have like BayCoast, we have a heat loan. So like it helps upgrade your utilities. Like if you needed a heat pump up to 10,000, oh, you can borrow up to 25,000, but it's at zero interest because it's a heat loan. We want you to improve the home. That's, even though it's zero interest, it's going to be a trade line because it's an installment loan.
Okay.
So it's not always something that carries interest, but it's something that you had to apply for, and it's a credit line.
What's a heat loan?
So it's anything that's kind of you can use it for anything that's upgrading your heat source. So it could be
Like someone has electric heat and they want to upgrade to natural gas.
I'm actually living this right now. It's kind of funny. So very unexpectedly, and the worst week of the year, my AC condenser is just gone, and it's not the newest. So I expected it within the next like 5 years. So I was getting quotes because I know Mass has a rebate for heat upgrades, and if I go to a heat pump, the Mass will cover up to 10 grand in a rebate for it, and then I can use the heat loan from BayCoast at zero interest for any difference in that payment. So I'm looking at, I like the way my gas source heat is right now, but electric heat pump, if it's paid for and it's, you know what I mean, and I'm getting a 10 grand rebate, it's something I at least have to think about because the Mass Save program seems to be pretty good. So that's the agony I'm living right now.
Oh, jeez.
Yeah.
So when you're building your credit report, like if you're a youngster, what kind of loans are good to have? We talked about a little bit of diversification. So you'll have your credit cards, and then as you move into like your early 20s or late 20s, if you have like the money in the bank, should you still maybe consider taking out a loan to add to your credit?
I mean,
score?
I know how it was when this is the kind of like my life experience of it is, and I think this is a great way, is having that first car loan is a great start.
Okay.
If you're it's obviously going to be an older car usually, and it's, so you're not getting the best interest rate, but sometimes where you could be the primary borrower, like the children could be the primary borrower. If you have that parent as like a co-signer, it'll help the interest rate of the overall loan because it's lower risk.
That's smart.
But it's their trade line, so they're still responsible for the payment. It's going to build that credit history without. You really just kind of have to weigh out how bad that interest rate is, because if it's an older car and they have no credit, it's going to be tougher because that's how an auto loan's dictated. You know what I mean? So auto loan rates are like right now, it's not great. You know what I mean? With the Fed raising rates, the price to borrow anything is pretty high. But that's how I would start it, along with that like debit or credit card that you can back with a bank account, or just have it as a trade line. Even if it's only a $300 limit, I think that's the best way to go at 16 to 18 or 19. That's where you should start at, either the auto loan with a cosigner or that small line credit.
Okay, that's great advice.
What happens when credit card companies raise your limit? Does that help you, hurt you?
Well, it's going to help with your 30% problem if you have a little bit higher balance, because now they see it's going to be marked on that trade line as he's allowed to borrow 20 instead of 10. So if your balance was $5 grand and the limit was 10, you were never pushing that 30, you're at 50%. They bumped it to 20, now you're only at 25%, 500. So I'm like, it's better for you as far as your credit. You just can't go crazy in that little. You just keep it to. That's why it's a percentage and not a dollar amount. So that's the way. It is good. Well, they are obviously going to raise your limit because they see he's not late. They don't know your earning potential, but they know it on the application.
Are they going to pull your credit to do that?
Oh yeah.
So like if your credit's frozen, you're not going to get an increase in your limit for the most part, right?
I've gotten letters that says your credit line's been increased, like from Kohl's or one of the department stores. It's been increased.
You get that a lot. I would say that they wouldn't. Yeah, if you were frozen, there's no way they would have access to see your credit score. They would probably be less likely to up your limit.
Mm-hmm.
So if it was you initiating it, then they would probably raise your limit.
Okay.
But if it's tough because they probably want to see that soft inquiry and that credit score if they're going to double your limit. You know what I mean?
Okay.
So if you have a lot out and you're thinking, gosh, I really want to I'm tired of making 10 payments a month. Consolidation loans, good or bad idea?
Yeah. I mean, it's again, it's case by case in what the cycle you're in. So if you see that you have 10 payments and you're making the minimum payments all the time and you're not seeing any of the balances go down, they're going up a little bit every month because you're spending a little, but paying the minimum payment, I think a consolidation loan is definitely the way to go, because those loans could be half the interest rate of your credit card that's at 28, or it could be even lower. You know what I mean? So paying interest to 10 different people is never a good thing. And especially with rates and the Fed raising rates, credit card interest rates are at an all-time high. So if you can consolidate it and have a goal, you can see the end, the pot at the end of the rainbow there, and you're like, all right, in this many years, I'll have it all paid off. That'll be stress-free. And then I'll have another $600 or $800 a month in my budget to do something else with, rather than just spinning my wheels and getting deeper and deeper into it. I would say it's always a good idea if you can have a goal, and it's the goal is much harder with 10 interest-only payments rather than a payment with a fixed interest rate that has an end game to it. I know I've seen people where at my old mortgage lender, I would refi them literally every 3 years because they were living off the equity in their house and overspending on credit cards.
Yeah.
And then their pain point was that when the payment got too high monthly, they would say, Mike, I got to consolidate. Can we refi and pull cash out? And it was like a 3-year cycle. So I was almost coaching them and being like, you're living above your means. It doesn't feel that way because you do have money, but your balances are getting higher. So it's like you're using your home as a credit card you know what I mean? So it's tough, but having that end game and a plan to get rid of the debt, it's super rewarding, and you can definitely get there with a fixed payment of installment. Just when you pay one off, or if we use a consolidation to pay off 10 of them, cut all 10 of them up if they're gone.
You're going to cut them up, but you don't want to close them, right? Because wouldn't that kill your credit score?
Yeah. So you want to keep the ones that don't have an annual.
But like, just forget that you have the card, so you're not going out and spending
they can still
again
exist, but
with
you're
the
not
loan.
spending. Yeah.
Right.
'Cause you don't want to go back into that. Then you'll have need multiple consolidation loans back to back. It'll just get ugly.
It will. It will get really ugly. All right.
Wow, that's a lot of great info, huh?
Yeah.
Oh my gosh. So, do you have any other messages you want to get out there to?
I mean, right now, everybody hears. It's news story after headline about the real estate market and credit and how rates have been going. I think when it comes down to it, these tips are just going to align you better to when you do feel comfortable in the market, or if you're already in the market, setting yourself up for having the least amount of debt or the highest credit score and being educated about stepping into that pre-approval process. So I think this is priceless information that even if you're not ready right now, or you mentally don't think you're ready, I think you should still dive into it, because the more prepared you are when you get there, it's just going to save you thousands in interest or mortgage insurance or whatever it may be. Having that higher credit score it makes it so painstaking. Nothing there to where you don't have any hurdles to cross. You don't have a deadline of I got to do this in a month now because I already have my offer in. You know what I mean? So it comes down to just being prepared as you can. I mean, we're going to see, hopefully, I don't want to predict anything. I always try to wish it into fruition, but optimistically, I want to see rates come down through the end of the year or into next year. But it all depends on the outlook, inflation, and how the Fed looks. But I try to stay positive and keep people in the market and just keep them educated on everything so that we can all hopefully get into 2024 and see it come back.
Last interest hike was the last one.
I've been saying that.
I think it was. We'll see.
You got the inside information there.
Hey, I would love it. I'll throw a party if it is.
Yeah. Let's hope.
right.
Let's hope. That would be wonderful if it was the last one.
Yeah.
Well, thanks. This was really useful. I learned a lot. I'm sure that you did too, and everyone watching learned a lot. Mike, I want to thank you for being on our show and providing us with such useful information. So
anytime.
It was really great.
I loved it.
Yeah, we'll be back again in our financial health series at some point to tackle another topic. As time goes
Yeah,
on.
I'd be interested in the best way for like kids to save and education for kids and stuff like
Absolutely.
that too.
Yeah, we can dip into it. Maybe we'll touch a few different topics.
Yeah.
Sure.
Yeah.
Yeah.
We can do that down the road.
Okay.
So thank you everyone again for watching our show. And if you'd like to become a sponsor, please contact us at 774-319-4230. Oh, there was a little dot there and I read it. Special thanks to Ron Gamache for our intro music, to the BioSkills of Northeast for producing our show, to Mike Taveira for being here and giving us such useful information,
thank
to
you, Mike.
BayCoast
Thanks
Bank.
for having me.
And of course, BayCoast Bank is just right for all of your financial needs. Visit baycoast.bank or call 508-678-7641 to learn more. Thanks, everyone.
Bye now.